Welcome to MacroEdge Radio. Please note that the content aired on this program is intended strictly for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. The opinions, discussions, and views expressed by our contributors, guests, and associated MacroEdge staff are their own and do not necessarily represent the official stance, strategy, or opinions of the MacroEdge organization or any of its affiliates. While we strive to provide accurate and up-to-date information, MacroEdge Radio makes no representation or warranties of any kind expressed or implied about the completeness, accuracy, reliability, suitability, or availability of the content of this show. Any reliance you place on such information is therefore strictly at your own risk. We do not endorse or assume responsibility for the accuracy or reliability of any information offered by third-party websites linked through the show or any website or feature linked in any banner or other advertising. We will not be a party to or in any way be responsible for monitoring any transaction between you and any third-party providers of products or services. All audio content of MacroEdge Radio is the intellectual property of the MacroEdge organization, and any use, reproduction, or redistribution of this content without the express written consent of the MacroEdge organization is strictly prohibited. All rights reserved.
Good evening, everyone. This is John Galt speaking.
Welcome to MacroEdge Radio number 9, where we discuss the summer economy and a new, interesting subject matter some of us have not heard before, but many of us will remember, unless you're not as old as I am. In which case, we might just sit there and teach you a little bit more. This is Friday, May 31st, 2024, the end of May, and a crazy time for everyone. What we have seen in the past 30 days as far as markets, the economy, the circus known as American politics, geopolitics, and all that is happening has really hit new all-time insanity, for lack of a better term. I hope everyone can hear me fine out there. We are running this thing and rocking and rolling. We're going to record this program. It will be re-edited as an MP3 and available, and hopefully introduced on our new YouTube channel for MacroEdge. You can go to YouTube, search for MacroEdge. You will see the channel. Everybody needs to subscribe to it. I might even go back to posting videos again, but not with yours truly charming face for radio, just charts and blather. Moving on, we do have a special. If you subscribe to MacroEdge.net at the Ozone, you can get 3 weeks instead of 2. Short-time offer. Take advantage of it now. As we move forward, folks, there is a theme that I think you should listen to. And I'm not trying to sit there and preach. I'm just trying to introduce this as a historian/economist, trying to tell you what I'm seeing from the outside looking in. And what I am seeing right now is a crazy situation. In my day, when a bull market ended, we called it passing out blindfolds and cigarettes. For those of you who are new to that term or have never heard that term before, let me just state that it is exactly what it sounds like. And what occurs is the bulls are handed blindfolds, offered cigarettes, and taken out and shot one at a time. Your favorite stocks, the ones that CNBC told you should love all the way to zero, the ones that Fox Business said will never go down, the ones that Bloomberg said are green investments and make Mother Gaia feel warm and fuzzy inside. That's right. We have to deal with this situation because reality is a very harsh thing. And when the blindfolds and cigarettes are passed out, there's no mercy. There's no good guys. There's just dead stocks, bears blowing out their rifle barrel, reloading for the next one, and people freaking out saying, but you told me. Here's where we're starting. The month-end review. The S&P closed at 5304 on 5/24 a week ago. I'm sorry I couldn't be here. I was sick last week. Today, it finished at 5277, down 27 points for the week, but still up for the month. Last week, the Dow closed at 39,069, finished at 38,686, down 380 for the week, 383 for the week, up 871 for the month. The Nasdaq closed at 16,920 last Friday. Today, 17,019, plus 1,000 for the month, plus 1,078 points. What's interesting is the S&P had 50% of its stocks still above the 50-day moving average. The Nasdaq 43.75% above the 50-day moving average. It was a volatile and violent month. And it's not about to sit there and end, guys. In fact, if anything, it's about to get a little bit more intense. Let's talk about passing out cigarettes and blindfolds. But first, let's talk about the speculative frenzy. We have equities that have been bid up in insane moves. And the first one that comes to mind is one that not too many people have heard of. Their claim to fame was they rang the bell at the New York Stock Exchange. That little bit of news catapulted a stock which focused on logistics, warehousing, and retransmission in Central America, primarily Costa Rica. It's called Latam Logistic Properties S.A., LPA, newly listed on the NYSE. On May 21st, that stock was $10.15 at the close. Today, it closed at $130, but that's not the story. In the interim, from the time that equity announced that it was leaked out that it was going to be put on the NYSE, it crept up all last week and this week, opening the week at $15, closing Tuesday at $28, Wednesday at $33, opened at $36.31 on Thursday, intraday high of $258, closing at $258.85 for the end of the day. Why is that interesting? Well, on May 21st, it traded a whopping 1,400 shares. On May 24th, last Friday, it traded 15,400 shares. On Tuesday, May 28th, when the news leaked out, it traded 178,700 shares. This is a very thin, low liquidity stock. On May 29th, 52,000 shares. On May 30th, 201,000 shares. And today, opening at $284.74, peaking at $525 before closing at $130, trading a whopping 94,657 shares. Boys and girls, this is what's known as end of bull run speculation to the nth degree. And if people can trade in it and make money off it, God bless you. Personally speaking, I prefer safety and security, and that ain't it. Another stock, which everyone's been looking at, has been Green Wave. It's a company which runs recycling. Now, why anybody would care about that stock, I got to explain this. Green Wave Technology Solutions out of the Carolinas and Virginia opened up May 1st at 6.6 cents per share. On May 31st, it closed at 3.8 cents per share. The high was 29.7 cents per share. On May 23rd, with a closing price of 8.9 cents per share, it traded 1.375 billion shares. What you are witnessing, boys and girls, everybody who's paying attention, is end of bond market, bull market excess. They're wringing it out. They're going for the crazy stuff. They're going for the insane stupidity of manipulating penny stocks, which have been up to 1/3 to 40% of all NASDAQ volume. Don't listen to your bubble visions. Don't listen to your Wall Street Journals and Financial Times, Market Watch, etc. Pay attention to what's happening. If you look at the top stocks that traded today on the NASDAQ, it would blow your mind. Of the stocks on the volume leaders, Novo Integrated Sciences, 307 million shares, up 60 cents to $1.05, 133% change. Green Wave, which there's a story behind that, 283 million shares, finishing up, as I said earlier. Faraday Future Intelligent Electric, one of my favorite stocks, opened up the month of May at 4.4 cents, closed the month of May at 58.3 cents, had an intra-month high of $3.90 per share on 5/18. At that point, it almost traded by itself 20% of all NASDAQ volume. If anybody has seen a FFIE vehicle on the road, please take pictures and send it to MacroEdge.net. We would love to see it. We really would. Crown Electrokinetics, 140 million shares, trading at 10 cents. Selena Hospitality, a Chinese casino operator, 9 cents a share, 110 million. And then we get into some regular, actually recognizable companies in the top 10. SiriusXM, Innovative Eyewear, Intel, and Apple. Why did Green Wave become so active? Well, Green Wave fell out of compliance with NASDAQ. So listen to this great bargain if you speculated in penny stocks and ended up without a chair and no music at the end of the day today. Chesapeake, Virginia, May 29th. Greenwave, an operator of metal recycling facilities in Virginia, North Carolina, and Ohio, today announced that it intends to effect a reverse stock split of its common stock per value of $0.001 per share of common stock at a ratio of 1 post-reverse split share for 150 pre-reverse split shares. Once again, speculators beware. Now, I don't care how much they reverse that stock. If it's trading at 4 cents now, it's worth 4 cents again eventually, and that's basically a zero. But we had the same thing happen in the dot-com era. We had the same thing happen in the speculative era of commodities. This is a repeat of the same cycles we've seen since the 70s, except it's far worse because we have a central bank, a Federal Reserve, which says, it's okay, go ahead and do this. What could go wrong? So let's talk about some of the big boys, some of the guys who got blindfolds on cigarettes. Dell Computers, May 1st, $124 stock. May 31st, $139 stocks. However, it did hit a peak of $179.21 on May 29th. So it got a pretty good whooping. MongoDB, the 52-week high in the stock was $509. May 1st, $365. Closed today at $236.06. Kiss that one goodbye. Salesforce, everybody remember that name, CRM. Had a high of $283.82 for the month. On May 1st, it was $268. Today, $234.44. It has become a bloodbath. And as a bear market begins to creep into the conversation, where you have a small group of high dollar stocks holding up the rest of the indices, eventually the speculative fervor will whittle out. The people will stop losing money, the apes on AMC, the idiots on GameStop, the whole 9 yards. Everybody will run out of cash. The credit margins will stop being extended. And in the end, those particular instruments, those particular equities will be liquidated without mercy. To close out my review of the markets for the month, gold started the month at $22.91, finished the month at $23.47, up 56 for the month. We had a lot of volatility, but that's all thanks to our central banks. Silver started at $26.39, finished the month at $30.55, up $4.16 for the month. I stand by my forecast once silver cracks above $35 per ounce, 50 plus is in play, and all new all-time highs probably will occur because nobody with any common sense believes a thing the Federal Reserve is saying. I'm going to divert for one moment to a local editorial, but this is an ongoing theme that we're hearing in financial and broadcast media. There's a Channel 13 WTVT out of Tampa. It is a Fox News affiliate. They're best for the weather, to really sit there and give you a, oh God, somebody just posted a picture of the first Faraday. I don't even want to think about it. Excuse me, guys. I don't even want to sit there and tell you why I'm bringing the story up, because it is a political story that they're trying to pass off as an economic story. The lead was that migrants are leaving Florida because of DeSantis' new illegal immigration law, which took effect earlier this year. Well, it's 110% bovine scatology. The new law verifies and legitimizes people who have the permits as migrants to work in the state of Florida in the field of agriculture. Those visas have always been honored in Florida and have been since I was a little kid. Never been a big deal. What it does do is actually sit there and promote the idea of legal immigration to sit there and handle all of our crops. We can't find local people to do it. It's an admission of failure, and it's also a problem that we're going to have to deal with for the rest of our known eternity until the robots take over. But what was very upsetting about it is they're blaming the high prices on Ron DeSantis and his act. It's a lie. It's an omission of fact. They're saying, oh my God, the prices went up on things like peppers because of this new law. No, the truth is our season ended 3 weeks ago. If anybody knows anything about migrant patterns, once the watermelon and potato season ends in North Florida and in South Florida, Immokalee, et cetera, everybody migrates to North Carolina, Tennessee, Georgia, Kentucky, Indiana, et cetera, to pick the crops there. It's a normal seasonal migration which occurs. But the media, by omission, sits there and wishes to promote this theory that we have a labor shortage because this is how things work, and you can blame a politician for inflation. Total bovine scatology. Remember, when you hear it on the financial media or the mainstream media, you have to keep that in consideration. It is not as it seems. In other news, frustrated McDonald's executives moaning about fast food chains' price rises. From the New York Post, May 29th, via Reuters. The McDonald's USA president, Joe Erlinger, complained about the $18 Big Mac meal. Excuse me for a second. Sorry about that. Still getting over this, and I'm going to be hitting the cough button every now and then, so you know how that is. Uh-oh, and I don't know why that's not. There we go. He is whining about the Burger Giant's pricing that he's hearing about in the media and why everybody is complaining about it. I got news for you, folks. I haven't eaten McDonald's in eons, okay? So when I see the prices, I drive through a drive-thru every now and then. I might get a coffee or something, and I just look at it and shake my head. The truth is, you have a cost of increase of insurance, transportation, logistics overall, the cost of the food itself, and, of course, labor, which is really beginning to cause a major issue in the western states as these stores close. Next week, in a special broadcast, we're going to discuss this with Kat B., who has owned numerous restaurant franchises and has worked in the restaurant industry for decades. Kat is one of the experts that I defer to. I don't have a clue about this stuff. I've never run a restaurant in my life. Next Friday, we're doing a 2-hour special starting at 8 p.m. Eastern. Don't miss this. It's going to be one for the record books, folks. The first guest at 8 p.m. is going to be fantastic. I don't know if you've ever heard of him. I was introduced to him this week. His name is Alexei Cherableski. He is an expert in private credit and commercial real estate. I don't want to sit there and say that that's an issue that we've been discussing in the MacroEdge community, but folks, private credit is about to become a major issue for our banks, and I'll talk about that in 1 minute. Kat will tie it all together, because guess who else uses private credit? A lot of franchisees, because there's some very large risk associated with opening a restaurant. And if a franchisee can't get guaranteed funds from the parent company, they probably have to go to private credit or a bank to obtain it for startup. We're going to sit there and tie all this together because it all seems to have a major impact on where the economy is going because of this long-term inflationary surge that we've been suffering through. And what is this long-term inflationary surge causing? Yahoo Finance via Bloomberg, Thursday, May 30th. Large U.S. banks may be exposed to commercial property, may be more exposed to commercial property than regulators appreciate because of credit lines and term loans they provide to REITs, Real Estate Investment Trust, according to a new study. The St. Louis Fed did recognize this fact, published a paper, and everyone's starting to realize that there might be something to this. Well, this was recognized by The Banker. It's a industry magazine back in April 16th to be exact. And the question was, how severe is banks' exposure to private credit? It's a global question. Well, I'll read the initial paragraph, and I'll let you determine how pertinent next week's 2-hour special will be. Private finance can overlap with banks in ways regulators are still assessing. Global private finance, which includes both private equity and private credit, have seen a rapid extension with annualized growth of nearly 18% since 2017, according to the International Organization of Securities Commission's September 2023 report, Emerging Risks in Private Finance. Why is that critical? When the crash occurred in 2007, it was realized that the governments of the world weren't going to authorize blanket financing for housing, commercial real estate, etc. Private equity, aka dark pools, had to fill that gap. Well, boys and girls, they filled the gap, but they also like playing craps, roulette, poker, blackjack, and that stupid Caribbean poker game that I've never really figured out at the casino. Because, after all, what could go wrong with an 18-year-old kid buying 4 Airbnbs in Southwest Florida? We're at that point now where all of these bills are about to come due. And that's why this upcoming show next week, this 2-hour special, is pertinent to what the economy is about to do. Right now, I'm going to bring Six up, one of our resident equity experts at MacroEdge, because what we're looking at is I don't even know what to describe this as, Six. An equity market with speculation run amok and a craziness and speculation that I haven't seen since 1999-2000. And if anybody has any doubts about that, you should check out what's going on at MacroEdge.net, with our writers and our experts. Six, you there?
Yeah, I'm here, John.
Let us talk about the markets, because I think I did my rant pretty well at the beginning of the show.
You did.
It smells like 1999 to me, or 2000. But you make the call, sir.
I totally agree with you. It looks exactly like that, honestly, in so many different ways. Obviously, there's nuances, but it looks exactly like 2000. I would compare it more to 2000 than 2008, just based on the way the asset prices are moving. But we also have the credit element a little bit, definitely in commercial real estate. This week, I saw tech start to falter a little bit. What was really notable to me was Salesforce, Dell, the way that they responded, the way that Dell was hyped up before this earnings report to be like a partner with NVIDIA, to be basically one of their like main partners for their data center expansion, and earnings were just not there. Tech is starting to look weak. Now, that's just in general. Obviously, today we saw at the close, I mean, from right at the news, yes, rallied 100 points. So I'm not going into next week feeling bearish, just in the short term. I don't think there's a whole lot to be, like, I wouldn't personally, as of now, be buying puts for next week, that's for sure. It looks very bullish for the very short term, but for the way that the market structure looks, the fact that the Russell had the strength for most of the day and the Dow, we've been watching the Dow versus the Dow Transports. The Dow Transports looks like it regained some strength. The Dow Transports looked really weak against industrials and the broad market in general, and we saw that kind of strengthen into the close, especially today. So, I mean, it doesn't look very bearish right now, just in terms of the market structure. But in the underlying fundamentals, I mean, they continue to deteriorate. We've seen that through all of the economic prints lately. Today, what was it, 1.3% GDP, and we have that while the government is deficit spending about $1 trillion roughly every 100 days to get 1.3% GDP growth. I mean, it's nonsense.
Well, what do you make of the fact that we had, and I hope you didn't mind me using that expression, blindfolds and cigarettes. I think that's what's happening right now, Six, is that we're witnessing a passing of the guard. Today looked like a mass liquidation of commodities, and what really blew my mind, after the news that Chile posted its worst monthly output for copper in years, copper still got hammered, but so did gold, silver, the softs, everything got hammered. It looked like people were raising cash either to speculate in some of the key Magnificent Seven equities and buy some bonds. Your take on that?
Yeah, I mean, it looks like the markers of the economy, of the actual economy, are starting to slow. yields rallied today. Stocks sold off with yields, which I thought was very notable until they reversed. I was really starting to question what was going on there, and if we maybe had finally somewhat of a correlation flip, but then stocks rallied through the end of the day. But I mean, stocks might be the last thing to really take note of what's going on. A lot of people are on the wave of higher for longer now. All of the articles out of the major Bloomberg, institutional research are pointing to higher for longer. And, you know, we came into the year thinking that we were going to get 7 rate cuts, and then that didn't happen. And now it's completely the other end of the spectrum, and we're talking about 1 rate cut. I mean, if you look at the PMI today, the GDP, employment numbers, unemployment is starting to tick up. 80% of states are reporting higher unemployment year over year. I think that I'll take the other side of that one, that it's going to be higher for longer, and I think they're going to be cutting sooner than people think.
Well, my take on this, and I'll discuss this with you real quick, is the VIX suppression has been amazing, but I still expect the possibility of a single-digit VIX in the next 2 weeks, as everyone's going to get their hopes built up heading into the Federal Reserve meeting. God knows why. I'm not even going to touch that one. But also, at the same time, there is a speculative fervor that it's an election year, so either party will sit there and protect the speculators. I don't understand why people don't recognize that some of the worst corrections we've experienced, and don't listen to the mainstream media, and Six will back me up on this, some of the worst crashes and corrections we've experienced have been in election years. 32, 2000, 2008, 2020 was no picnic. Six, where is this theory that election years are bullish for markets coming from other than the usual pump and dumpers?
I think that we usually see people talking about, you know, whoever the current member of the presidency wants to stabilize the markets, make everything look really good before elections. And I mean, they obviously do. Like, I'm sure Biden is doing that right now. He is doing that right now. If you look at the deficit spending, he's absolutely doing that right now. And now all of a sudden he cares about the border security when he couldn't have cared less about it for the last few years, but now right before the election, obviously he cares. That's comical. But and that's obviously what they're doing. But I think the fact that, just like you outlined, the fact that an election year means anything in terms of the market has to automatically go higher in an election year, that's obviously nonsense. It's just there's no way that that's true.
Well, it's a fascinating thing to witness as far as the economy and the political aspects of it. What is scary about this is there is this abject ignorance of the consequences of what's occurring. And I'm seeing this on a weekly, daily, etc. basis, where we seem to have a masses, especially in the 18 to 30-year-old age group, who've never experienced a true bear market in their lifetimes with their own money in real estate, other assets, God forbid, the options market, which they're going to learn about the hard way, and, of course, equities. And here we are with the smart money trying to send a signal that, folks, there's something wrong. The fact that high yield is still trading like a AA bond is grossly an exaggeration of the current situation. Would you not agree?
Yeah, I think so to clarify that, all of the institutional research that you're getting out of the banks right now, the big banks, it basically says that, you know, you want to lock in yield here. They're all saying the same thing. You want to lock in these yields before they go down. And I think that's a major driver of the fact that credit spreads are as tight as they are. I think they're way too tight. I think that there's no doubt about it that they're too tight, but that's my opinion. But I don't think it's going to play out the way that they think it is. I mean, I would own treasuries, but I wouldn't own any other bonds right now except the highest grade corporates. Like I would own JP Morgan's bonds, I would own Apple's bonds, Microsoft's, Google's. Not many other bonds I would want other than those.
110% agree, and I think that is the key. I also think that a lot of people are getting suckered into this idea that commercial real estate bonds are going to be a haven or safety along with mortgage-backed securities, which once again, the Fed has offered no indication that they're ready to sit there and start buying those again. 6, why don't you plug what you're doing over at MacroEdge.net and let everybody know there are options for people to sit there and look at for research on our website.
Yes, there are. We're managing a equity research book right now, the vision book. A little bit about our positioning in there, I guess I'll share. We're long China. I don't feel very good about that one after the last couple of weeks, but we're on the cusp of getting out of that if it doesn't turn, but we're up on it. Long some utilities, especially the ones that are possible beneficiaries from the AI data center bull run, ones that have nuclear exposure, short regional banks that have.
Oh, 110% short the regional banks. That has been my long time ticker. You there? Sorry about that, 6. Yeah, the regional banks are definitely a reason to be short, in my opinion. There's no guarantee there's going to be a bailout for those suckers, that's for sure. Oh, we seem to have lost 6-6. I'm going to sit there and go ahead and drop you off and bring Mr. Awesome on, the ever-famous Ulysses Awesome, because we're going to sit there and proceed now to go ahead and merge into some of those situations and talk about the bigger economy. It is a situation that people don't want to talk about, but you look at today's PMI at 35.4. The last time we had a reading that low was in April of 2020 during the peak of the pandemic. Guys, this is not a normal situation. This is not what you would expect to see in the long-term bullish economy. When the PMIs are getting below 40 on a regular basis, it is a disaster waiting to happen. And it means that the economic outlook is not as rosy as it appears. Mr. Awesome, welcome aboard, sir.
Thank you, John. I'm always glad to be here. How are you doing today?
Pretty good, sir. Feeling a lot better than I did last week. I have my voice back, even though it's not exactly the charming Frank Sinatra-type singing voice, and I have to hit the cough button every now and then.
Well, you've got the golden pipes of radio, so.
And the face for it, too, sir. So what do you make of the economic data this week? I think the PMI is the biggest screaming red siren, red flag that we have.
We have a lot of them. I'm kind of at the point where I'm wondering at what point bad news is bad news again. I don't think it's just the Purchasing Managers Index. I think it's been across the board what we're seeing. We had unemployment claims. They were basically in line again, which I think everybody's got some issues with. But as we've discussed internally in the MacroEdge group, we have a bunch of states that unemployment insurance is basically an impossibility and a non-starter. We have some states that pay $30 a month or $30 a week. So I'm not seeing anything on the horizon, whether it's the PMI or Kansas City Fed Labor Market Index. I'm not seeing anything that's turning the tide from negative macroeconomic news. I'm just seeing more of the same.
Do you think that the concerns suddenly expressed by the Federal Reserve, Jamie Dimon of all people, who must be short, and others about commercial real estate are some of the early red flags, sort of to what we heard from us, we were called screaming memes in 2006. From the screaming memes in 2006.
I do, actually. And if you were to go back and look at the patterns over the years, 2006, even first quarter 2007, being indicators where Federal Reserve members first acknowledged cracks in markets, whether it was, quarter one, Bernanke talking about subprime is contained, it's not that bad. And going back to 89, Firea and talking about things weren't that bad, but then we had 4,000 banks, savings and loan institutions go under. I think that is a red flag, and I think it maybe is a red flag that's closer to the bigger problems of recession than some of the ones we've talked about before, because by the time the Fed chairman or Federal Reserve board members are talking about the risks to the market, it's a little late, as they always are.
Well, here's the thing. I would like to talk. Go ahead, Six. I'm sorry. Go ahead.
I'm going to chime in on this one. And I think another thing to note about Jamie Dimon's comments in particular is that Jamie Dimon is – I couldn't have more respect for Jamie Dimon. Jamie Dimon runs the biggest bank in the country. Their whole business model is based around – he talks about it all the time, maintaining a fortress balance sheet. And then the other side of the business model is scooping up companies, other banks, once they fail for pennies on the dollar. Like, he couldn't have better risk control, and he has the dominant position in the market. There's no reason for him to sugarcoat anything because he's not going to lose clients in crisis. He's only going to gain clients. Like, when the regional bank failings happened early last year, J.P. Morgan gained an enormous amount of deposits. That people were just walking in with, $10 million plus checks into J.P. Morgan banks because they just didn't want to take the risk. Like, if you're in a small regional bank and regional banks are getting iffy, like, do you want to play that game? No, you just want to take your money and yank it and bring it to J.P. Morgan Chase or Bank of America. Like,
yeah, you're seeking security at that point. And
exactly.
I'll elaborate on that, Six. I agree. I'm critical, but at the same time, I can also appreciate Jamie Dimon and what he's done. I can be overtly critical, but I'm going to be the first one to say I'm not in his shoes. So we'll start there. And also, you elaborated on something that's very real in all of business. Flight to security, right? Whether it's in the banking industry and it's J.P. Morgan and Jamie Dimon and what he's done, or in the home building industry. What I'm looking at on a daily basis is, despite a lot of my reservations and frustrations about the industry, I look at D.R. Horton and Lennar, and even though they posted some disappointing earnings, I look at it in the same context. If there's a flight to safety in the industry, it's going to be with the ones that are at the top of the industry, that have the most control over the situation, that have the most access to safety and security. That's a great point you brought up there. I think flight to safety has always been something we've talked about amongst U.S. Treasuries, and we're kind of an interesting point in time right now where all these things are pertinent and all of them have some relationship to one another, whether it's J.P. Morgan and flight to safety of deposits, whether it's investing or working with an entity like D.R. Horton or Lennar, or what treasury markets are you investing in?
Well,
all part of the same cycle.
Well, I'm going to throw this out to you real quick because we have some wild cards out here. What bank, in your opinion, Mr. Awesome, and Six hops in with this also, of the majors, and I have my own opinion on it, it starts with a C, it might also end in a C, as far as the symbol goes, have exposure to the idea of an unwinding of the carry trade. The Japanese yen has not behaved well despite over 90 trillion yen being used to support the currency. and the Japanese 10-year bond, the JGB, accelerating over 1% the past week. They lose control of that aspect of the yield curve control. All bets are off on what may occur as far as the carry trade occurs. Don't you agree?
I think Six could probably speak more in depth on the actual carry trade itself. My personal take on it is basically looking at on currency exchanges and where we're at in the cycle as far as what are each currency value to one another and how are their economies being affected and what's going to make each country's currency stronger or lower in the short and long term.
Yeah. All right. So I'll speak to this one a little bit. I mean, I don't know which banks have the most exposure to the Japanese yen carry trade. I haven't done that research, so I honestly can't say that I have any idea. But if I was going to pick a side of it, and I wouldn't even be directional on it, but I would say that I expect USD JPY to become more volatile. I would definitely be long that currency pairing's volatility, but I really have no idea which direction it goes in the short term. People are advocating for the BOJ to hike in July. Internally, their rhetoric doesn't sound like they're going to do it, but really, who knows?
Some of the leading currency. I hate to talk over you guys, but I'm going to throw a monkey wrench into it. Two of the leading currency experts I listen to, from Societe Generale and of course Axel Merck, have both speculated, and they've talked about this openly, that the 170-180 range is not an unreasonable outcome for the yen. And I don't think the American public or investing public is aware of the implications of what that would do to our bond markets if we get those levels. Your take on that, guys?
Well, I don't think the American public at large pays much attention to the markets, whether it's bonds, foreign currency exchange, or even domestic asset prices. I think, and that's not a knock. I think most people just want to live their lives, and as long as their daily life isn't interrupted by price increases, most people have some sort of general ability to be happy about that. And I think that's a good thing. But then, we're left poring over the details of it. And I guess problematic, because then you start getting into monetary policy, you start getting into foreign trade, and diplomatics. And where do you go at that point? We're talking about whether or not the carry trade unwinds. We've got political instability. All these things are factors. I guess the best thing I can offer on that is that I agree with Six in the short term. I think we can expect to see more volatility in price levels, especially for currencies. But I don't think that we're at a point where we can say we've got a clear path towards a currency being worth X against Y, at least not where we're at. We're not technically in a recession yet, while we've got other major world economies that are in a recession. So we're kind of at a strange place where we just have volatility in the near term.
Fantastic. All right, I'm going to bring Mr. Awesome. Stay on here because I'm going to bring something in from Tricia and something that's new that's appearing in Southwest Florida and now Texas and other places. And since you're in this field, I want your take on this, because how many listings are actually shells? There's no measurement criteria for this, but we're starting to see shells, which for those of you who don't know what that is, that's basically a frame and a roof and dirt underneath, an incomplete home with a slab. This is starting to appear in our listings in Southwest Florida and Central Florida, and as I do more research, other people are pointing out in Texas through the MacroEdge group. This is a new phenomena that we didn't even see back in 07, 08, where people are saying, hey, you can buy this property for an absurd amount of money and complete it yourself however you want. Is this not one of the most dangerous speculative games you've seen in real estate in your lifetime? Oh, there he is.
Are you asking me?
Yes, sir. Because you've had the exposure to private real estate, residential building, and it freaks me out. I worked at it from a supplier logistics standpoint back in the first crash. This time, thank God I'm not involved in it. I'm involved in something even worse. Go ahead, sir.
It's hard to imagine something worse, but kudos to you for that. There is, in my opinion, there's enormous risk in taking over any project that is unfinished, especially if you have to pay money out of your pocket to acquire it. There's kind of an old thing, if it's for sale and it's 95% finished, there's only 95% left to go. And it's because you don't really know the details of what's transpired, right? So I'm going to put this in the context of if I'm actually evaluating the deal. And I have. There's been a couple of these developers, small developers that have gone under at homes are shells that piqued my interest in digging further. Here's how I look at it. When did the permits get issued? When did the work get started? And how long has it been unfinished? Elements are the worst thing for all properties. I don't care if you're building a skyscraper, a warehouse, a bridge, or a house. Elements, rain, wind, ultraviolet rays, are the kryptonite of buildings. When you have just a lumber frame of a house that's exposed to rain, wind, and sunlight for an extended period of time, with no protective coverings, with no temperature control, you're creating a future disaster for mold, mildew. With a lot of these products that we're using, they have formaldehyde in them, especially laminate strand lumber. You're creating an ecological situation that is very problematic. So if you're acquiring one of these deals, you really need to do your research to understand what you're buying, how long it's been sitting, and what the basis is. Because there's more issues than just the price points at risk in doing these deals. More often, you're better off just knocking it down and starting over, but that basically wipes out all of the value that's there. And really, these properties in the past cycles, they've sat for so long that a lot of times the cities wind up knocking properties down and then paying additional money to someone to come in and develop them.
Oh, you mean Blackstone?
No, without Blackstone, really. I mean,
I'm just throwing that name out.
Yeah, no, right. But really, like, this is a cyclical thing in real estate.
Yes.
Right? So developers get overconfident. They overextend themselves. With every cycle, a handful of them wind up defaulting. They can't pay their bank. The bank wants nothing to do with it. Taxes get behind, and it goes back to the city on the city tax rolls, right, for tax foreclosure. Well, then the cities have to go out and say, how do we get somebody interested in taking this property off our hands? And usually, it's either somebody buys it for $1 or, they might buy it for more than that, but the city puts in 2 to 5 times more than what the purchase price is through tax increment financing or some other city bonding structure to get somebody to develop the property, because nobody will touch it with a 10-foot pole after it's had those kind of problems.
There's something I want to bring up with this quick, if I can.
Welcome aboard, Joseph. Thank you, sir.
Yeah, sorry, I'm just kind of
no problem.
in here like the Kool-Aid guy.
Oh, you're cool. Go ahead.
You guys were talking about the shelves. So, if you're a consumer, if you're a potential home buyer, new family, what have you, what's a better deal in your opinion? You get into a shell that's marketed as, oh, you can finish this yourself, without maybe doing, all of your research. And I can't, just as a quick side note, I can't remember which home builder it was, but recently there was one that's getting a class action suit against them because of their home design versus where they're building the houses. That in the ventilation, the mold builds up.
D.R. Horton.
So D.R. Horton. You get these instances where they need to sell these shells, or maybe some of the other houses on the market. What's the better deal? Let's say you're looking at a house that's already overpriced for $500,000 that hasn't been redesigned since the 80s. So you're going to have to do, substantial redesigning of that by the time you're going to sell it, or you're looking at the shell of a house. I mean, to you guys, which one do consumers float to? Because they're both sort of in the same boat, right? Like we're in a position where housing prices and asset inflation has increased exponentially in the last 4 years since COVID. So you're almost on the back foot from the get-go. So now on top of that, if you're going to be a real home buyer, home owner, you're going to spend time redesigning a house. You're going to want to update it because these are things that are going to build equity. But a lot of the houses that I'm seeing in my area haven't been redesigned since the 90s. There's a house that we've talked about in the group chat a couple of times. A guy bought it in the 70s for, I don't know, probably $40,000. Hasn't redesigned it since the 80s. Has lived in it till now. And, I think it's 1,600 square feet. It's got a two-car garage, $500,000. Now, are you going to buy a $500,000 house on a lake or not that already is going to need to have substantial upgrades done to it? It makes everything more difficult. And when you get cases like the shells coming up for sale with the marketing that you can, design the rest of them however you want, or home builders that are facing lawsuits, at what point do consumers just pull back regardless of whether or not they want to buy a house?
Great questions in addition.
Well, it's more of a rhetorical question, more just like a thought provocation, I guess, of anything, because these are the circumstances that home buyers are in right now.
Yeah, I guess all I want to do is reinforce that. There's a phrase that exists in this business, caveat emptor, which means buyer beware. I would urge everybody that's buying anything to beware that at any point in time, you could be buying something that is not beneficial to you, and therefore you should do as much research and educate yourself as much as you can on what it is you're acquiring. Whether it's your home, an investment, because at the end of the day, only person that can quantify is a shell or a lake home or any new home worth it is you, the person buying it, right? Like I can counsel, I can run numbers, I can give information, I can tell you about the risks and the rewards of each one. But at the end of the day, everybody who's buying has to represent themselves and put forward what their desire in life is or what they value. If what they value is that they don't have a lot of cash, but they have a lot of time and a lot of skill, then who am I to say that buying a shell is less or more valuable than anything else to them?
I'm going to throw this out to you, Mr. Austin, because I was looking at the Zillow listings, which is not always accurate because it doesn't show the for sale by owners, of course. And I take Southwest Florida only because that's my primary residence, as y'all know. As of Thursday, Lee County had 8,411 listings. Population-wise, it's substantially smaller than Hillsborough County, which is the Tampa area. That does not include Pinellas, which only had 6,753 listings. We're on pace to exceed the listings at the peak of the crisis in 2008, as it appears panic selling, regardless of the stage of construction, or if it's completed, or if it's falling down, or if it's boarded up from the last hurricane, we're on pace to put so much property up for sale. Isn't the risk of dilution greater than anything we've seen in 15, 16 years?
Yes, absolutely. I think that there is something that gets missed in the housing market and housing analysis, right? Neely Taminga talks about it on here a lot, about how consumers are efficient, right? They will shift from buying a value meal at McDonald's to buying 2 pizzas at Domino's. You can't tell me that doesn't exist in a housing market, right? If someone says it's going to cost me $3,500 to own a $200,000 home that I have to repair, doesn't also weigh it costs them $1,500 to rent a home for 1 year that they don't have to pay anything more than $1,500 a month into. They're going to economize. And part of that is why we have the lack of sales that we have now. Rates are, I guess what I'm saying is demand is elastic, right? It can increase and decrease. If we have cheap access to credit, people will buy and spend more and more on a home. If credit is difficult to obtain or expensive, then people become economizers and they stop spending, and then prices face pressure, negative pressure, because inherently, right? Everybody who has an income or a budget or doesn't, you don't have unlimited dollars, unlimited funds. You know what you can spend every month. You know what your situation can do. Even if you're slightly shooting above that, right? No one's so delusional most people are not so delusional that they will spend more than they can afford every single month to buy a house. So we are witnessing the contraction in sales the way that we did in 06 and 07, the way that we did in 2000, the way that we did in 1989, the way that we did in 1982. It's not new. People can't afford it, and therefore they stop selling them, and that puts negative pricing power on homes. It's just a reality.
Absolutely. And even though we have insurance costs starting to come down in Florida and property tax are pretty much fixed by the homestead exemption, most people don't seem to understand this is still a speculative market because there is an anticipation of future population growth. But betting on the curve is not the wisest thing in the world. Mr. A, you were fantastic. Please let us know when your next TV appearance is occurring. We want to tune in for that for sure.
Much appreciated. Always a pleasure.
And Joseph, you and I are going to talk a little logistics real quick before we close this show out. Today there was some news from the layoff tracker. I see he's in the room listening to the program, and we appreciate his updates about CHEP shutting down their Knoxville, Tennessee facility. Now, for those of you not familiar with this, CHEP had the great invention, which I wish I had thought of 30-plus years ago, where you paint a standard standard pallet blue, put a serial number on it, and charge shippers to lease it. And you sit there and you come up with other containers, et cetera, and they're shutting down an entire facility in Knoxville, laying off over 100 people. We're starting to see downgrades on trucking and transportation companies, downgrades on air cargo, rumors, nothing confirmed yet. I'm still trying to nail it down, of Amazon beginning to close down some distribution centers, with layoffs on a large scale occurring in certain departments, especially Audible and some of their AWS aspects. Is this the beginning of the logistics contraction to meet actual demand, in your opinion? And do you think that we're at risk of seeing, with the sky-high shipping container prices, an impact, a secondary inflationary wave hitting, unfortunately, during the election and Christmas period?
Well, I think, so the freight market in general, especially trucking, and we followed this since really mid-late 2022, early into 2023, we were starting to talk about this. Freight's been, at least trucking has been in a recession for the better part of the year. Capacity across the market has been an issue. Now, Oceanic spot rates jumped up a little bit this last week into this week. So this is that's the third time, by the way. The first two times it was just kind of I think one was holiday related. Another one was they had supply chain problems. everything from droughts, fuel prices. There's been a ton of volatility, but the main part of it has been capacity. And MSCI has been building out a new fleet for the past few years, and they're expected to take shipment of a couple of those this year. So really, the recent spot rates, in my opinion, is more of a byproduct of just the overall tightness. Everything's kind of spread out. There's been slow steaming for the better part of a year, I would say now. Blank sailings, all sorts of things that are used by companies to kind of maintain or stimulate spot rates, right? With trucking, it's been a little bit different. Just after COVID, when everyone was online buying stuff, they needed that extra support to handle the extra capacity consumption, to absorb that capacity. But what they didn't expect was that to drop off so quickly. Not to mention there was insurance costs. Insurance for everyone's up 22% over the last couple of years, and they're expecting that to go up a little bit farther. But trucking, fuel surcharges, all sorts of other things. So they've been battling, trying to find this moving goalpost as to where are we going to find a stability in demand and capacity we have, and they just haven't found it yet. So every time we see these jumps in spot rates, everyone kind of gets on board with, did freight finally find a bottom? And air freight over the last few months has become more popular just because it's been more cheap. Now, the Biden administration this year had passed a sustainable fuel memorandum, I guess you could say, or guideline for air freight. So you could see a little bit of volatility from that. But it's a game of capacity, right? Nearshoring is starting to take effect. That's something that I've been following over the past couple of years. I believe, I've had a couple articles on it. So there is a chance through intermodal, and speculatively, intermodal could start to rebound. If we're going to start to see action in intermodal rebounding, it's going to be probably late summer, early fall of this year, as the nearshoring efforts start to take a more firm foothold. We are seeing increased volumes over in the port of LA, but the Asia trade just kind of isn't there yet. So when you start to see all this happen, you have to start to wonder, is the nearshoring, we've done it in the past, it's happened in the past, but how serious is this investment going to be? And we're still too early to tell on that.
Don't you find it unusual that the USMCA, and for those of you that don't know what all these acronyms that we like to throw out in abbreviations, is the United States-Mexico-Canada Agreement, basically NAFTA 2.0. One of the aspects that's dismissed in it is the permissibility of Canadian and Mexican truckers to operate inside the United States, thus adding to capacity and denying American truckers more volume intrastate, interstate inside the U.S. In the old days, we would sit there and pick a shipment up in El Paso, Nuevo Laredo, Brownsville, etc., run it to Dallas to a railhead, run it up to Kansas City, etc. Now the Mexican carriers can carry it all the way to Chicago and leave the country with 2 or 3 more loads before they depart, and they can operate at a lower operating ratio than an American carrier can without the same oversight and employment regulations, even though they claim that they have that. I believe the odds are stacked against American truckers unless something changes in a revisement of that agreement.
Yeah, and that's something that I think when they started the conversations for the nearshoring in Mexico, they needed a win for Mexico. They needed to kind of incentivize a little bit more, right? So who always ends up losing when the U.S. wants to start new trade agreements? It's the workers in the U.S. that do it. And I'm not saying that to knock Mexico or any other, region that we trade with, especially in something services like the trucking industry. However, there is a certain level of incentives that are offered that kind of naturally put domestic resources on kind of a lower playing field. But long term, I think what they're trying to achieve is a more stable supply chain that's cheaper for everyone, and while shifting the momentum from Asia and from going coast to coast to the southern states. We've seen growth in Georgia. We even have a large hub that's getting updated in Tennessee, and the reason for that is they want to redirect some of this traffic to make the supply chain, they call it more resilient, more effective, whatever. Usually it ends up meaning someone's losing their job. Either way, over long terms, it's meant to make the supply chain cheaper for everyone. It's always kind of a guessing game with Mexico. We've done this in the past.
Oh, yeah.
And I think the incentives with the Canadian versus the American trucking, it kind of goes hand in hand. You know, we're scratching Canada's back, they're scratching ours, while we both try to stimulate Mexico. Because Mexico is, you know, our closest neighbor. Border talk aside, there's a lot of potential there. So I think, even though it's unfair, I don't think it's meant to be that way. But yeah, I agree with you 100%. The American side of it is they're gonna bear the brunt of that cost and volatility in the sooner future.
I've run large fleets, and my anticipation of this is that the competitive aspect, the good carriers will be fine. However, the small to mid-sized carriers are going to get obliterated, and this has been the issue from day one. It's not a matter of the treaty being unfair. It's the idea that we think that by simplifying and turning the supply chain into a more budget or economical model versus the long-term growth and sustainability of the American transportation network could indeed backfire and be inflationary in the end, especially if we get into another trade dispute with Mexico, which, believe it or not, people, has happened historically.
Oh yeah, I mean that's always going to be something that's going to happen, and I think you're right on that. You know, there's a lot of room to grow in that industry, but at the same time, there's also a lot of risk of greater inflationary pressures, and that can manifest in many different ways. Politics is going to be the first one, just because, yeah, we're in an election year. Biden's going to be signing legislation on the border. When you take a path that we have taken in the last couple of years with nearshoring, you run those risks inherently. So you kind of just have to hope that in long term, the federal government, Biden administration, knows what they're doing. And not to mention, if Biden does, somebody else, we'll just say, ends up winning as president, you don't know if that administration is going to change any of those things. So yeah, you're totally right on that.
Well, the reason I bring this up is I have this nagging feeling, and this is what I'm going to call, and maybe I should write an article about this at some point. The article tonight that I'm going to publish is blindfolds and cigarettes, by the way, boys and girls, talking about the markets. But on the transportation side of things, the Amazon effect, while positive from the consumer point of view, from a logistics point of view, it would appear they've overbuilt capacity for warehousing and distribution, and that is going to have a crushing impact on the industry for the next 5 years, or at least the next 3 years. What's your take, real quick?
Well, certainly. So we've talked about in the past that some warehousing projects have been pushed out. Amazon is one of them. They're actually delaying the opening of over 21 locations. I know it's over 1 million square feet. I'm not exactly sure on the exact number, but those things are meaningful. You know, warehousing capacity is going to be growing into this year. It was planned to be growing into this year well into 2022. Some of these projects got started while the freight boom was going on, right? So they're going to start pushing them off. And especially with the nearshoring, I want to see, and what I'll be looking for is if there's going to be Amazon and other warehousing investment is going to be saved to be put over in Mexico for the transoceanic railway, because that's going to really kind of solidify the fact that they're going to take the nearshoring seriously, and Amazon would be a big player in that. So yeah, there's warehouse capacity that's coming online that is going to be tight in certain regions, but a lot of that, unsurprisingly enough, is down in the southeastern states, kind of up the eastern seaboard, a couple places. And I will say Port of LA is tight on warehouse capacity right now, but I wouldn't say it's anything out of the ordinary. That's basically, I think that's seasonal. Because, you know, they're having to look into how to warehouse differently. It's not just about where they're going to place warehouses to store or to be near a railway hub or anything else like that, but it's also what they're going to be doing there. Since e-commerce has been taking up, some of the warehouse space that we're seeing is being converted into like a hybrid warehouse space, so it's like a split between e-commerce and more traditional type of warehousing. So that's kind of new. while at the same time, a lot of these companies are heavily integrating AI into quote-unquote streamlining their business. Like I said, usually that means someone loses their job. In this case, it's going to be warehouse workers. Inventory management, interconnectivity between other third-party logistics customers. It seems to me that what the trend for warehousing will be going forward is a hybrid mixture, is a hybrid between traditional warehousing for solid goods as well as e-commerce to kind of spread more goods out and in more locations with the hopes that somebody in New York who orders whatever from e-commerce has the same lead time as someone in southern Texas who orders the same thing. You know, that's always the synergy that they want to achieve, and a lot of them are using AI to do that. And that's part of when I say that there's no real consumer value added to AI. That's part of it. Because these warehouses, we have a lot of them here in Southwest Michigan. Obviously, more geared towards auto parts and stuff like that because of the automotive manufacturers. However, we have a couple of Estes hubs here and other third-party logistics and LTL carriers too that will be affected by that, especially since Estes has bought the Yellow Court distribution centers. So we're going to not only see a change in warehousing capacity, but we're going to also see a change in how warehousing is used. And I think there's arbitrage opportunities there that people are seeing that they want to try to capture by mixing it between e-commerce and standard, or regional items.
Fantastic, Joseph. That's okay, sir. Thank you very much. I'm going to throw the statistic out for everybody who's not paying attention. The Long Beach, Los Angeles port terminal is measured in TEUs, which is the container 20-foot unit for standard measure. We're up 16% in April, 24% year to date. However, the disturbing facts in the numbers are we're down 20% roughly in April, 18.4% year to date unloaded to outbound containers, and empties outbound is at an astonishing 35% exiting LA Long Beach. So what's happening is trade is once again turning into a one-way street. And while we try to blame China for everything, for all of our problems, what you have to understand is that Long Beach, Los Angeles, and other terminals also bring in things from Central and South America, Australia, New Zealand, and also all of Southeast Asia and Far East Asia, Bangladesh, and parts of India. You have to think about this in larger terms. We can't simply sit there and say, well, it's just China. Japan, Taiwan, the entire region has to be taken into summation. And with this trade war beginning to heat up, Joseph, I got a bad feeling that the disruptions we're about to see on our East Coast are going to, on our West Coast, I should say, are going to benefit Mexico tremendously. And I'm a little bit jealous that I'm not younger and can go back down there and deal with that at this time.
You know what? You're right. They probably will. More recently than not, especially in the LA ports, there's been a kind of lingering of empty containers. So lot fees will rack up for those containers, and they're starting to be pressed a little bit more. It's usually a sign that goods are not moving in both directions, like you say. So you have empty containers kind of stacking up in yards that have nowhere to go, just like you have open containers that aren't being shipped out because they don't have anywhere to go yet. So these are not places that you want to see that happen, that can get that type of congestion happen, because it kind of speaks to a greater trend in the overall market, I think, and that is there's not a lot of questions. People are not having their fingers get the goods out to stores. Restocking happens. They pulled restocking forward a little bit sooner to capture low spot rates, and now that we're seeing warehouses that have basically been filling over the last few months, those regional spots, and this happens to be the West Coast, a lot of things, you're going to see that start to happen. So all of those companies that for the past decade, we'll say, have been rerouted or have been routed over to California to grab one can, come across, drop it, get another one. They're all now having to reroute that type of volume. That's always changing over this period where we're shifting kind of away from the Asian trade. And there's discomfort with that, of course, because now you're not just sending the the same volume trucks, the same places. So as they're trying to figure out where the consumer is, where's the real balance between demand and capacity, you get these mismatches for probably the better part of 18 months. And I think you're going to continue to see that too.
Joseph, thank you very much. And please, everyone, follow our Substack. Go to MacroEdge.net, sign up for the Ozone Special. 3 weeks instead of 2 free, so you can get a picture of what we're doing. We've had the holidays interrupting everything. We'll have another series of holidays coming up on July 4th and Labor Day. Next week, Alexei will be joining us. Alexei Chernobynsky will join us to talk about private credit and commercial real estate, a situation that I don't think a lot of people are paying attention. It's one of those crises that we've been discussing in the MacroEdge group in great detail, yet a lot of people don't seem to understand it has the potential to bring it all down once again because the banks are lying about their exposure. And of course, Cat B, Dead Cat Mountain, she is a follower of the MacroEdge group and a member. You can follow her on social media along with Alexei. And guys and girls, I will tell you, we're going to find out the real status of the middle-class consumer by doing this. We need to know who is actually eating out, who is participating, who has the disposable income. I don't think it's what most people perceive it to be, despite what these chains announced in their quarterly earnings. So, John.
Well, I just want to add that. We've been talking about this. I'm going to be digging deeper into it, especially with consumer, and I think it would be great for if we have some speakers on it, the buy now, pay later. So that's expected to grow over $700 billion by 2028, and with the transparency problems, I think that would be a great caveat to really gauge where the health of consumers are. That's what I want to know is who's putting the Walmart and the grocery workers, not all of them are grocery workers. Who's doing that? There's a big spot there that and they want. So I think that's.
Well, Joseph, I'll tell you right now, there was a ruling by the CFPB, the Consumer Financial Protection Bureau. I don't know if you saw this on Wednesday, that this BNPL is to be treated under the credit card regulations.
Yes, I did see that.
So that means the transparency is going to be there, or they're going to be, and companies like Affirm are going to be in a lot of trouble if they try to duck those regulations.
You're right, too. And on top of that, the Walgreens and Walmart have introduced their own buy now pay later, which directly competes with Affirm, who they last year expanded their cooperation with. So you're going to start to also see and see how the other companies can Affirm and market share. And I think you're going to see some competition.
Sounds good. Joseph, thank you so much for your participation tonight. Thank you, Mr. Austin. Thank you, Six, for your market update. And, folks, thank you for tolerating my extensive 1.5-week rant. Believe it or not, you can catch COVID-19 again. Not a big deal. It's a bad cold with a backache. You will not die. You will survive if you're in decent health, and take care of yourself. Just, please, take care of yourself. Take care of your family. Give your cat. Give your dog. Give your family a hug, for God's sake. Let's tune in next week for our 2-hour spectacular. This is going to be a program to remember. And don't forget, go to MacroEdge.net, subscribe, join the Ozone, check out the Vision, and also, you might want to check out the little website called JohnGaltFLA.com, because I'm pushing the same thing and want this thing to grow beyond everybody's imagination. So, MacroEdge Radio, this is John Galt speaking. Good night now.